In this video, I'm going to be breaking down the strategy that made me 5 figures in 2 weeks. Now, this is not the first time that I'm making a strategy video, and that is because I have different strategies for different market conditions. We have market seasonality, which means certain things work at certain times. And in the current market that we have, the strategy that I'm about to show you is the one that I think works the best for me. So in this video, I'm not only going to be showing you the technical part of this trading strategy, but also the risk management, the psychology, and everything that you need to build a profitable strategy. So I don't just necessarily want you to copy exactly what I do, but I want you to look at the way I have structured my system so that you can create your own system. Just because it works for me does not necessarily mean it's going to work for you, but you can take pieces from my system and implement into your own, just like I have done with my own systems. So without further ado, let me show you exactly what trading strategy I've been using recently and how you can build your own strategy using my system. These are the things that we're going to be talking about today. In the middle, you see my trading strategy. To the left of that, we have ICT concepts, market maker models / or plus premium and discount. We have journal and pre-market game plans. We have the psychology aspect of any trading strategy. Then we have my take on risk management and how we identify when we should put on risk and when we should put off risk. That is something that a lot of people don't think about, but it is something I would argue that it is the most important part of a trader, is to be able to identify when they should size up and when they should size down. So all of these 4 concepts combined is what makes my trading strategy. Now, obviously, I understand that the majority of you are interested in the technical aspect of this trading strategy, but you have to understand that these other 3 parts, the journaling, the psychology, and the risk management, is even more important than the technical part. Now, the technical part we will get into, but I want to start off by talking about the journal that I keep and the pre-market game plans that I make and how much of a difference it has made in my trading after I started implementing pre-market game plans on a regular basis. A lot of people will say, yeah, I know, journaling is good and we should do it, but a lot of people half-ass it or they don't do it at all. Now, journaling is one thing. That is extremely, extremely important because you'll never be able to identify what mistakes you're making, what conditions you perform best under, what times you perform the best under, what economic data has to be present for you to, win more. All these things is almost impossible to understand and really get to know unless you're keeping a journal. Now, the pre-market game plan is, in my opinion, just as important, but especially for building confidence within your system. So let me show you some examples of a pre-market game plan so you understand exactly what I mean when I talk about my pre-market game plan. A pre-market game plan is our approach to the market with defined rules that limits the possibility of failure. And here are some examples. Something I will typically write is, what did the overnight session look like? Did we trend? Was it a large move that happened overnight? Because then certain things can happen. We can expect a flat market because all the participants that we could expect during New York session was active in Asia session or London session instead. And it often just turns out to be a less probable New York session. Then I have gap up or gap down day. This is primarily for stock traders or futures traders like myself. I pay a lot of attention to whether the market gaps up or whether the market gaps down. Sometimes the market doesn't even gap at all, but I want to identify whether the market gapped up or gapped down. And the reason for this is because certain things can happen if we gap up, certain things can happen if we gap down. And I believe understanding the regular trading hour gaps that happens in the futures market and in the stock market is essential to understand, because I have taken a lot of losses in the past because I didn't understand gaps. Now, economic data is also something that I pay a lot of attention to. I'm not a fundamental trader. I don't pay attention to fundamentals. To be fair, I don't care what the outcome of the news is. I don't try to predict it. I don't trade it, but it has a lot of stuff. It says a lot about the market, what we have on the agenda for that given day or even that given week. Therefore, I always include the economic data situation before, I put on a trade or before I even start working for that given day. Let me give you an example here. If I trade on Tuesday and we have, CPI on Wednesday, I can expect Tuesday to be a flat market. There's no participants because everybody's waiting for CPI. All the big orders are waiting to get filled in at CPI, so they're likely not going to trade Tuesday. all the volume is waiting to be released. Therefore, Monday and Tuesday is likely going to be a flat market or just lower probability conditions because we have larger economic data throughout the entire week. The last thing that I pay a lot of attention to is the key levels that I'm watching for that given day. I like to mark them out prior to the market open because that gives me a lot more confidence the longer I've been looking at a key level. Some of the trades that goes horribly wrong is when I start to, 3 hours into the session, I come up with a new key level and I take a trade off of that level that I've been monitoring for 5 minutes. The best trades are the trades that I take from key levels that I've been watching for hours and even before the market open. It just gives me way more confidence to execute my trades, and therefore I always make sure to include whatever key level it is that I'm watching. Not only that, but something I pay a lot of attention to is to whether we hit certain key levels in the pre-market session. Because if all my objectives has been hit in the pre-market session, I am not going to trade that day, okay? I have lost a lot of money doing this that I could have avoided if I just paid attention to whether the key levels that I wanted to see get hit or a reaction, whatever it might be for that given day. If they were hit during the overnight session, there's no reason for me to be trading because the move that I originally had to be a part of already happened. So here's an example of my pre-market game plan. This is one of my personal pre-market game plans, and I write this every single day without fail. So we had CPI plus unemployment claims on the agenda pre-market, expecting a highly volatile New York session. 40-point overnight session also indicates that larger participants either waited for the CPI/unemployment claims or are still waiting for the 9:30 open. Market is currently trading near all-time highs, which means I have to favor longs because I simply can't do anything else. Given the uncertainty, I will remain de-risked on my positions until the market becomes more clear to me. Ideal scenario is a run below the overnight lows into the annotated hour one imbalance and then look to ride the market long. Then I always post a screenshot of whatever time frame I want to. In this example, this was a 1 hour time frame that I took a screenshot of, and then I posted it up in here. Then I said, would I ideally want the news to shoot into the annotated hour one imbalance and then possibly provide a long from there. We will see what happens though. So again, this is good because this will allow me to later on look through my pre-market journals and see, am I able to predict the market pre-market? How often am I right about what's going to happen for that given day? And that is why I take a screenshot like this. So I have, my thoughts pre-market, and then after the market closes, I'll write down my thoughts after, and then I'll compare the two, right? And again, this just gives me way more confidence so that if we ended up coming into that hour one imbalance that I marked out, I would have way more confidence executing a long because I know that I took and, I made this decision when my head was clear. I had no bias within my head. There's no emotions involved when I write this, right? I'm not even actively trading when I write this. So I know that the decision that I took or the ideas that I had here are rational ideas. A problem that a lot of people have is that they will have a certain opinion on the market before market open, and then that opinion will change completely because their mind starts to play games with them. An example here is that let's say you enter a trade, right? You had a certain idea before you hit buy or sell. As soon as you hit buy or sell, your mind automatically starts to come up with 1,000 reasons why you should not have hit the buy or sell button. And that'll automatically make a lot of traders close their positions or, just manage their trades horribly. And that's because these traders don't understand that they cannot listen to their brain after they hit buy or sell because that is irrational. You have to always refer back to what you were thinking before you hit the buy or sell button, because before that happened, you were thinking clearly. There was no emotion involved. After it happens, you cannot trust yourself after you've hit buy or sell, which is why I use the pre-market game plans, because I know that I had no emotions involved. I had no bias. I had no nothing, which is why these pre-market game plans, in my opinion, are just essential. And I rarely see people use these. I actually got this idea a couple of years ago from Umar Ashraf. He's big on journaling, great guy. But I saw him do these pre-market game plans. I thought they were really interesting, and I tried them out. Ever since then, I feel like it's just been helping me with my confidence, just my trading overall. And, it is just more data collection. In the more data that you have in this industry, the better, okay? People don't understand that, but the more data you have, the better. So that was the pre-market game plan. So give it a shot. You can copy whatever I did here if you want to. You can make your own. I don't care. I just want you to try it out. Try to actually dig deep into the pre-market game plans and see if your confidence changes or just your overall trading. The next thing that I want to talk about is risk management, which in my opinion is the absolute most important part of any trader's career. As a trader, you have very, very little control over anything. You cannot control the market. You cannot control the outcome of your trades. The only thing that you can realistically control is your position size. Okay, that's all we can control. That's our risk management, which is why I think it should be a top priority for people. You should, to dig deep into the risk management part, because realistically, that's the only thing that they can control. So I want to talk about how do we identify when to put on size and when to put off size. Okay, this is extremely important. It's very important that you know as a trader when the high probability conditions are there so that you can size up during those times, and when the lower probability conditions are there so that you can size down during those times. One of the ways that I look at this, and there's a bunch of ways by the way, is through the economic data. So as I mentioned before, if I am trading, let's say I'm trading Thursday and we have NFP on Friday, I am fully aware that Thursday is likely going to be a very flat market, right? There's likely not going to be as much opportunity on Thursday, and there's likely going to be different price action, or certain things might not, certain levels might not hold as they usually would. Price action can just be extremely weird when you have such a large economic data drop the day after. So that is one way I identify lower probability conditions is, if I'm trading Thursday, we have NFP on Friday. Either I'm not going to trade at all on Thursday, or I know that no matter what happens, I will lower my position size during or on this Thursday, right? Because I know that the probabilities of this working out is a lot less than usual. So I would rather have less risk during times like that and high risk during times where I'm confident, right? So that is one of the ways that I identify whether I should put on risk or off risk. Another way, I do this every single night or every single day, I look at the overnight session activity. And what I mean by that is, what did the overnight session do, right? Look at the electronic trading hours chart. We'll take a look at the overnight session. If we had a bunch of activity during Asia session, just a trending market, it moved 80, 100 points during Asia session. I understand that London session and New York session is likely not going to be very good price action. It's likely going to be a flat market because all the participants were, participating in Asia session instead. So that is a really, really great way to figure out whether today's price action is going to be good or bad. Look at the overnight session. If we had a very trending market, right, a huge range in the overnight session, expect London session in especially in New York session to be bad. And so if I come into today and I see that the Asia session simply just trended, I will likely either not trade for that given day, or again, I know to put off size. I'm going to risk less, right? Because these circumstances are not in my favor anymore, or at least I cannot expect as high probability setup to appear. And if they do, I can't trust them as much, right? And that's when I know, okay, this is not worth it to put on risk here. I have to put off risk. The last one is market conditions, just overall. And what I mean by that is, I have certain things about my trading that because I collect data, can see, okay, when this happens, I perform bad. So one of my biggest flaws in trading is trading a very, very one-sided market, meaning that we have a market that just goes up or a market that just goes down with very minimal pullback. Those are the markets that I struggle the absolute most in. And so if I can see that this is likely going to be a day where we are just going to trend to the upside with very minimal pullback, and I have certain things that I look for to be able to identify that, I'm either not going to trade or I'm going to take off size, right? Because if I take a look at my data, I can see that whenever I have a market like this, I tend to lose money. So either I'm just going to stay out, but if I want to trade it, I'm going to trade with less size. This is why the journal is so important, because the only reason why I know that I perform very, very bad under very one-sided markets is because I've kept data for so long. And I'm very quickly able to see that, okay, this is when I lose money. This is when I lose money. I would never understand this if I didn't keep data, if I didn't journal my positions, right? My thoughts, my emotions, everything. I would never be able to look and find my mistakes if I didn't write it down somehow, right? How can you expect to figure out what mistakes you're making if you cannot go back and see, through your data, when am I doing good? When am I doing bad? It's as simple as that. When you're doing good, figure out what the market looks like. When you're doing bad, figure out what the market looks like and then compare the two, right? So for example, some people tend to perform very well under consolidating markets. And some people tend to perform very well under very trending markets, right? But it's very hard to figure out what you are performing your best under without keeping data. It's almost impossible, which is why I think that nobody can expect any results if they're not keeping data, okay? This is not a very time-consuming business in that way. There's not a lot of boring stuff that you have to do. So journaling is the bare minimum, in my opinion. If you can't do that, well, then you cannot expect to be successful. Last thing that we're going to talk about before we dive into the technical part of this video is trading psychology, okay? Because this plays a huge role in my success, in my opinion, and understanding the importance of your mind is extremely, extremely important. Now, I know a lot of people will listen to what I'm about to say, and then they will think, oh, that makes sense, and then they'll go ahead and forget about it next day, right? But this is something that I value very, very high. This is something I pay a lot of attention to, and it's basically my state of mind before I get to the charts, okay? This is probably the best tip that I could give someone out there for longevity in this game. Being able to identify your emotions and then base your workday off of that. So for example, my biggest losing day that I ever had was a day where I woke up, I had an argument with a person that I love. I had not eaten at all. I was in a bad mood. I had slept bad. So everything was against me this day. I still decided to trade, and that was the only day where I decided to break all of my rules and lose a bunch of money, okay? Now, after that happened, I understand that if I wake up and my morning starts off with something emotionally traumatic, like an argument with somebody you love, whether that be your wife, your girlfriend, your mom, your dad, whatever it might be, that has a huge impact on your trading, whether you realize it or not. It has. So if I am not on top of my game mentally, I will not trade, okay? Even though I personally think that I probably could go on the market right now, even if I had a bad day and still perform very, very well. That is what I think, but there's no reason for me to put on that extra risk of possibly letting my emotions take over. Instead, I'm just going to call it a day and I'm going to wait until my mental is on top of this game again. So being able to identify your emotions and then basing your trading day off of that is absolutely key to longevity in this game, if you ask me, and not a lot of people pay attention to it. You can see it with a lot of famous psychologists when it comes to this industry. We take Mark Douglas as our example. He is the father of trading psychology. In his book, Trading in the Zone, he explains where, I actually don't remember if it was in the book or in an interview, but I heard him say it. And it's basically all the largest losses of the largest traders have something in common, and it is something emotionally traumatic that happened to him on that very day, whether that be an argument with the wife, with somebody at work, just something that affected their mood, also affected their trading, right? Because they had their biggest loss on that very day. That is something that they all had in common, and therefore I try my absolute best to avoid it, and I think you should too. And then the absolute best tip that I could give somebody when we're talking about trading psychology is to be able to detach your mind from the money aspect of trading, okay? That is very, very hard. We all get into this game of trading because of money, but we have to trick our mind into thinking about good habits and rules instead of money, because money is a byproduct of following your rules and building good habits. So we have to think about our days in a, did we follow our rules and build good habits, and not in a, is our P&L green or is it red? Because in my honest opinion, you can have a very, very green day and that still be a bad trading day. Just as you can have a very, very red day and that still be a very, very good trading day. So do not for 1 second go into trading and think that if your P&L is not green, you've done bad. That's not how it works, okay? I identify my winning days as, did I follow my rules? And if I did, it's a green day, no matter my P&L, right? Same goes for did I build good habits? Did I follow my good habits? If I did, it's a green day no matter the outcome. So the outcome of your trades really has no significance in my own opinion, or at least a very, very minimal. What's important is if you're able to follow your rules and build good habits. So detaching your mind from the money is the easiest way to beat the game of psychology when it comes to trading, because if you break it all down, it all comes back to money, okay? So every single psychology error that people has is related to the fact that their brain wants money. If you can detach your brain from the money, you win, and I guarantee it. So now we're gonna talk about the technical part of this video, which I'm sure the majority of you, tuned into this video for. So there is a singular concept that I utilize over anything, and that is going to be market maker models. Okay, it can be very confusing. It can look very confusing. A lot of people have a very, very confusing way of teaching it. I personally feel like I've simplified it enough so that it's pretty repeatable and understandable, because the problem that a lot of people have is that they create unrepeatable systems, right? They create systems that are so hard to repeat that it just becomes stupid, right? So what I've done is try to make a system that has as little human input as possible, so that I can, just look at a market and follow the rules that I set for myself. So as little human input as possible. It's not mechanical at all, but I want to make it as simple as possible so that I can repeat it as often as possible, and so that I don't have trouble identifying my own system, right? That's a big problem with a lot of people. They have trouble identifying their own system, and that's crazy to me. So this right here is a perfect example of a market maker sell model. Now, the whole idea behind these market maker sell models is we have a curve over here, which is called the buy side curve. And then right over here, we have the sell side curve. Now, the buy side curve of a market maker sell model is this right here, right? It's a move up, consolidation, move up, consolidation, move up, and then a consolidation, and then the market maker sell model starts. Now, the whole point of this over here is for the market to engineer sell side liquidity for this curve to come down and take. So this entire curve here is only made to trick traders into thinking that the market is now in an uptrending market. And so a lot of people will place their stops here because they long somewhere around the consolidation. Same thing goes for here. They place their stop somewhere around here because they long somewhere around here. So the whole entire purpose of the first curve of any market maker model is to engineer sell side liquidity in this example, for then the sell side curve to come down and take out those stop losses. That is how we identify a market maker model. Now, the reversal point is up here. Some people call it smart money reversal. I don't know. It's just a reversal. The way that we anticipate this is by looking for higher time frame PD arrays, specifically fair value gaps. I don't really use any other PD array on the higher time frame other than fair value gaps. So if we, for example, say that this is a 5-minute time frame that we're looking at, the higher time frame PD array could be an hourly imbalance or a 4-hour imbalance or anything above, right? So if we have a 1-hour fair value gap up here and we start to consolidate and I see a displacement leg down after the consolidation, my mind automatically thinks that this is the beginning of a market maker sell model, okay? Now, how do I confirm that, yes, this is indeed a market maker sell model and we are going down here to finish that sell model? Well, the way that I personally identify it is by looking for the consolidations that we have here. So what you will get if it's a true market maker model is a consolidation followed by an expansion. So a lot of people will tell you to enter off of the first consolidation. I do not agree with that whatsoever. That is simply too risky for me because I don't know whether this is a market maker sell model or not, or at least I don't have enough confidence to be executing within this first consolidation. The first consolidation is what we call the first stage distribution. Just so you understand that, if anyone ever mentions it, that's what it is. The first stage distribution, I would never recommend entering here. It's simply too risky for me. What I do is I wait for the consolidation and then I have to see an expansion lower. Once I get the expansion lower, I'm waiting for another consolidation to appear, and that's when I'll look for my entry. So I never look for my entry during the first stage distribution. I always look for it during the second stage distribution. Does that mean that we can never look for an entry in the first consolidation? Absolutely not. It all depends on your confidence, right? If you are very, very confident that the market wants to run lower, then you can try a first stage distribution trade to catch the best possible entry. And yes, I've done it many times myself, but I always risk way less when I do first stage distribution trades rather than second stage distribution trades. So again, first stage or first consolidation, we after that get an expansion lower or displacement lower. If we then consolidate again, my entry is 100% of the time going to be the optimal trade entry from the previous consolidation high to the most recent swing low. That right there is going to be my entry each and every single time. Stop goes to the previous consolidation high, take profit goes to the market maker sell model end, and this is exactly what it looks like. This right here is, in my opinion, very repeatable. It's not super hard to understand, and it basically happens every day when you're trading a 1 to 5 minute time frame like I am. And again, consolidation, right? Expansion, consolidation. What can we then expect? Expansion, right? We're simply just following the flow of the market, and we are combining that with market maker models and liquidity, right? So we have a higher time frame point of interest hit. Doesn't have to be a fair gap, can also just be a high swept, just a significant liquidity pool, followed by displacement, consolidation, displacement, consolidation. Second consolidation, I will enter on optimal trade entry, because if this is again a market maker sell model, the first consolidation or the first stage distribution highs should never be swept, which is why I like to place my stop, if possible, at the highs of the first consolidation. Because yes, if this is a true market maker sell model, these highs should not be swept. There's one more way that you can get an entry with this model, if you ask me, and that is by utilizing the premium and discount tool, specifically equilibrium. So if I don't enter off optimal trade entry for whatever reason, maybe I don't expect the market to come all the way up there, I will use equilibrium from the first stage high to the most recent swing low as my entry. So equilibrium right there would have been my entry. And typically we will have some sort of PD array that overlaps with either equilibrium or the first zone of the optimal trade entry, whether that be a fair value gap, an order block, whatever it might be. If it overlaps with it, the better. Like, that's better, right? If it overlaps with either one, it's going to make the trade way higher probability. And a little secret here for market maker models is typically with the expansion that happens after the first stage distribution, it will leave behind some fair value gaps, because obviously this happened with a lot of volume. Now, if the time frame that you're looking at has two imbalances, the top one is 99% of the time going to hold, and the bottom one is 99% of the time going to fail. So always trust the second fair value gap in market maker models and not the first one, in my honest opinion. And the second one will often overlap with either equilibrium or optimal trade entry, which is why this model has such a high win rate, because I understand exactly how market maker models work, because I've used them for so long. And that is something that I've personally picked up along the way. If we have two imbalances in a market maker model, the top one is going to hold and the bottom one is going to fail. This right here is the exact same thing for if you want to go look for longs. You simply just flip this, right? And then you look for a market maker buy model. I'm going to show you some examples of my most recent trades using this very setup. So here we are. This was a trade that I took last week with the community. And this is a perfect example of the strategy that I just explained. Now, obviously, it's not going to look as clean and it's not going to be as easy to identify when you're looking at actual price action, but hopefully this will make you understand exactly how I trade. This right here was without a doubt an A+ setup. And the reason for that is because this high right here was swept, and that created an SMT divergence. Now, an SMT is very simple. If you have two correlated assets like the Nasdaq and the S&P 500, and one of the two sweeps the high and the other one doesn't, that's an SMT. It's something that we see behind a lot of big moves in the market, and therefore I really enjoy when my setup has an SMT behind it. This one did. The Nasdaq swept this high, The S&P 500 didn't. That's an SMT divergence. This right here, this very low was a low created at 8:30 where we had high impact news. So this is something that you can call a data low. Let's type that out. Data low, right? So data lows and data highs is something that the market is very attached to. It's something that it will often come back to. It's also a low that stands out a lot, low hanging fruit, as some people call it. So I have a significant point of liquidity down here that I'm interested in, right? Not only that, I have an SMT divergence up here that also confirms that this low is going to get hit next, because we had an SMT, meaning the S&P didn't sweep the high. So there's obviously a lack of volume when it comes to moving higher. Now, when that is then followed by displacement like we have here, that immediately tells me that the market wants to move lower and not higher. Again, why? Because we have a lack of movement going above highs, but we certainly don't have a lack of movement going below lows, right? If you were a smart brain here, you would be able to identify the power of three that was also involved in this setup. A power of three is when you have a consolidation, you have a manipulation, and then you have the distribution. Okay, so I have plenty of videos explaining the power of three, or the AMD, whatever you want to call it. And this right here was also supported by that. So I had a lot of confluences for this trade, which is why this strategy is not mechanical. Okay, I try to make it with as little human input as possible, but it's definitely not a mechanical strategy. Certain things like this make the setup way higher probability. Okay, so I have an SMT, I have a power of three, and I have a data low. That is all I need. Then, as I just told you, we got the displacement here, right? Then we got the consolidation that I was looking for. So based off of what I just told you before, when we get displacement, consolidation, and then displacement again, I am going to look for my entry in this next consolidation that's about to form. And what did I say my entry was going to be? It was going to be the optimal trade entry drawn from the first consolidation high to the most recent swing low. That right there is going to be my entry. Now my stop is going to go to the highs, and my take profit is going to go to the low that I'm anticipating to get hit. So this right here was the exact setup that I just showed you before, but this was a trade that I took live with the community. So let me play it out here. And as you can see, the market just did exactly as I expected it to do. This is a perfect sell-off scenario. Everything was in alignment here. And the more things that you have, aligning with whatever you're trading, the higher probability this setup is going to be. So again, as I said, we also had a very nice fair value gap that overlapped with the optimal trade entry of this smaller range, which again just adds to the position. It just makes it higher probability, and I had high confidence in this trade. Now, again, why did I have high confidence? Because I had so much confluence telling me that this low was going to get hit next. SMT, power of three, displacement, consolidation, displacement, a fair value gap that overlaps with the optimal trade entry, and then there's basically no way that we do not go to this low, or at least the probabilities are heavily on my side, which is all that I can do. That's like, obviously this setup can still fail, but again, the probabilities are on my side, which is all I need to be consistently profitable over a longer period of time. So again, this was a perfect example of my trading strategy, the current one that I use. Now, does that mean that I'm going to use this strategy till the end of times? No, because market conditions can change, and certain things may work now and they may not work 2 years from now. So no, this is not going to be my strategy forever. But this is the one that I'm using right now, and the one I've been using for a long period of time at this point. Now here we're going to look at the last and also the second trade of last week. I only took 2 trades, and these were the 2 trades. And this is the last one that I'm going to show. So again, a picture perfect example of my strategy. The only thing that was missing here was an SMT, and this would have been an A+ as well. If the S&P had swept this high, this would have been an A+ setup. Unfortunately, we didn't have an SMT. Does that mean that I'm not going to take the setup? No, it's not. But it goes back to the risk management department. So I risked less on this position than I did on the other one, because the other one I had way more confluences. Okay, I was way more confident. I had an SMT, I had the power of 3, I had a lot of stuff aligning, which is why I identified that, okay, now is the time to risk more. And the very next day, I identified, okay, Now is the time to risk less. So already there, I'm able to identify conditions. I'm able to identify whether this setup is a high probability setup or a lower probability setup. This one was still a very, very good setup, but it was definitely lower probability than the one yesterday. So either I'm going to do normal size on this one or I'm going to risk less depending on the circumstances. So again, very simple. Buy side curve here and sell side curve here. That's sort of what I was anticipating. And this low right here would be the end of that market maker sell model. So what do? Well, I look for the previous consolidation, which is a very, very small one, but it's still a consolidation. This one here, I draw my fib from the high of that to the most recent swing low. I use the optimal trade entry for my entry, and I exit at the market maker sell model end. So this was, again, the setup just like the one yesterday and just like the one I showed you with the drawn out example. We have a market maker sell model. We have the first consolidation. I didn't enter there. We have the second consolidation. I'm now going to enter from the optimal trade entry of the first consolidation high to the most recent swing low. Again, what do we have that overlaps with my optimal trade entry? We have an imbalance right there. What do we have down here? We have another imbalance. Now, if you remember what I told you previous in this video, I said in market maker models, trust the second imbalance, not the first one. So this one up here, I'm going to trust. This one down here, I'm not going to trust. And this is exactly what the setup looked like. I'm going to play it out. And there it was. Again, very, very beautiful trade. Textbook play. If we just had an SMT somewhere up here, it would have been even better. Unfortunately, we didn't. But that does not mean that I'm not going to take the setup. So again, exact same scenario. Buy side curve here, sell side curve here. Now, let's quickly talk about why I anticipated this to be the point of reversal. And if we go to a 15-minute time frame, you'll be able to see that that high we made there was the only high of the entire leg. So we have a high here, 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 and here. So the only reason why I anticipated this to be the point of reversal is because it was the only high of all these highs that hit a higher time frame point of interest, which in this case was a 15-minute imbalance, right? So that's what started the sell side of this curve, which if we go back again to the beginning of this video, I said that the majority of the time, the market maker buy or sell models is going to start by hitting a higher time frame fair value gap. When I'm trading a 1-minute time frame like I am here, a 15-minute fair value gap is a higher time frame fair value gap. So that is why I anticipated this to be the start of the market maker sell model and not here, 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 or here, right? So that is exactly why I knew that if this was a market maker sell model, this would be the high of it. All right. And yeah, same exact setup, textbook, very, very clean. And this is the model that I've been following for the longest. And it made me over $10,000 in the last 2 weeks, which is absurd. I've had really, really good weeks. It's simply just to show what's possible. It's not normal for me to make 10K in 2 weeks, but I did. And it was using this exact setup. So I really hope you enjoyed this video. I hope it helped you understand exactly how I view the market. Now, again, this is not my one and only final strategy, okay? It does not mean that this is all I'm ever going to trade. It does not mean that this is the only times where I'll be entering a trade. This is just one of my strategies that I really, really enjoy using, and especially recently. Again, I hope this video helped you out, whether that was the risk management department, psychology, whatever it might be. I hope it helped you out, and I hope it helped you understand how I view the market. Thank you a lot for watching, and I'll see you in the next video.